Okay, Assalamualaikum warahmatullahi ta'ala wabarakatuh. Alright, this video is dedicated for the topic 3. Sorry, not topic 3, topic introduction, but on the third part of the introduction, which is on the general presentation and disclosure requirements of financial statements for Islamic institutions. Yeah, in our case, basically for the Islamic banks. Okay, I'll be talking or delivering to you the guidelines, okay, uh, which has already been outlined by one, the Malaysian Financial Reporting Standards 1, which is basically the standards to be referred to by all Islamic financial institutions in Malaysia, as already being required by the policy documents issued by Bank Negara. Well, at the same time, I will also be discussing with you the requirements or the guidelines outlined by the Financial Accounting Standard 1, okay, on the disclosure as well for the financial statements by the for the for the Islamic financial institutions as issued by IOFI. Yeah, so I hope with these three guidelines or standards on the presentation and disclosure of financial statements can give you an overview of how the financial statements of Islamic banks, yeah. Okay, so we will go to the first standards. Okay, that means the MFRS 101 on the presentations of the financial statements. Okay, these standards is basically prescribing, yeah, the basis of the presentations of the general purpose financial statements. Okay, still, although we are talking about the financial statements of the financial institutions, but the presentation, the disclosure, and also or the presentations of financial statements is this still based on the general purpose financial statements. Why? It is because this is to ensure comparability. Yeah, comparability uh, for the financial statements itself with other institutions or other entities, as well as comparability within the institutions or entity, but of different periods. Okay, I think you are very familiar with this in terms of the content or the financial statements that is required to be published or to be prepared by entities, yeah, as being outlined by or as being prescribed by MFRS 101. So you should be familiar. All entities should have these four financial statements. Okay, the first one is the statements of financial position, followed by profit and loss, the statement of changes in equity, as well as cash flow statements. And of course, not to forget the notes to the account that will help the readers or users of the financial statements to get more understanding about those figures presented on the statements. Okay, so there's no difference between Islamic banks, or I would say financial institutions and other entities in the case of the financial statement. The financial statement should comprise all this, very similar. Okay, what's in there? What's in there, which also very much the same because we are referring to the same, MFRS, yeah, which is MFRS 101. This is the content of the statements of financial position, which you are very familiar. You should be very familiar with this, which means disclosure of all assets, all categories of assets. Yeah, you can see the assets from the last liquid assets to the most liquid asset, which is the cash and cash equivalents. Okay, and you have also trade and this one J is already the liabilities or obligation. Okay, what other things that you should be presenting are the issued capitals and reserves. Yeah, they should be there. Okay, the next and in the case of assets and non-current assets, same goes with the normal entity. So there must be a distinction between current and non-current. Yeah, call it current and non-current. If it's assets, means current and non-current assets, as well as current and non-current liability. Okay, what what is a threshold for distinguishing between current and non-current is basically the period, yeah, of the item, which whether it is more or less than 12 months. Okay. All right. In the case of statement of profit and loss or and other comprehensive income, all right, it's very much the same, which means it will reports or presents the profits or loss and as well as the total of other comprehensive income. Yeah. Um, what else? Okay, so you can see in addition to item required by other MFRS, the profit or loss sections or statement shall include line items that presents the revenue presenting separately, interest revenue, I think you're aware of that, gains and losses arising from the recognition of financial assets measured at amortized cost, well, this is the finance cost, impairment losses, including reversal of impairment. Yeah, impairment losses or gains. Okay. So it's not different there. Okay, now the second one that is the call it the requirement. I'm just going to be talking about the main financial statements, which are the statements of financial position or SOFP, and also the statements of profit or loss. Yeah. Okay, the second guideline or the second prescriptions that govern the financial reporting in the Islamic financial institutions is issued by Bank Negara Malaysia. Yeah, so they have Bank Negara Malaysia issued guidelines on financial reporting in the form of policy document. So with respect to the financial reporting, the Bank Negara has issued the latest one on the policy document, which is issued in 2019, but it has been effective as of 2022. Yeah. So what exactly required under this policy document? All right, it says that under the IFSA and also FSA 2013, is reiterating the act that financial institution is to prepare its financial statements in accordance with the MFRS. Okay, subject to any standards as may be specified by BNM to reflect specific modification or exception to MFRS. If, let's say, what does it mean by this? If, let's say, to show the true and fair informations, okay, within the Islamic financial institution, if, let's say, it is needed that, you know, and it is needed that a reference is to be made other than to MFRS basically issued by MASB, then it is allowed or it is permissible. Okay. And BNM envisage that such modification or exceptions will only become necessary in circumstances where alternative prudential measures would not be adequate to promote the financial resilience of the Islamic financial institution or address threats to financial stability. This is a very strong reason, yeah, if only that would not be adequate to promote financial resilience of the Islamic financial institution or to address threats to financial stability. These are two reasons that would allow financial institutions to make reference to other than MFRS in preparing the financial statements. Okay, this is mentioned for the Islamic financial institution. It is mentioned in section 74 of the Act. Okay, where such modification or exceptions are specified by the BNM, this must be accompanied by a disclosure of the fact by the Islamic financial institution. Okay, so because this is a very serious thing. Okay, so in other words, the policy document is very serious about it. So only any divergence, okay, from the MFRS is only allowed for two reasons. One is to promote financial resilience, and second one, if only by not by following the MFRS, it will give a threat to the financial stability. Okay, the main objective, of course, is to clarify and set minimum expectation for the applications of MFRS and to ensure adequate disclosure. Yeah, and adequate disclosure in the financial statements, and of course, and facilitate assessment of the Islamic bank's financial positions, performance, and Sharia compliance. Right. Other than that, okay, it mentions also on the what okay, all right, okay. What else? Islamic financial institutions shall also comply with the resolutions of the Sharia Advisory Council. This is another item of the governance executed by the Bank Negara. One is through its policy document. The second one is through its Sharia Advisory Council. Yeah. What does this SAC govern? It is on the applicability of the following accounting principles adopted in the MFRS. Yeah. In other words, the Advisory Sharia Council basically issued a endorsement, yeah, on certain call it principles, accounting principle, whether it is Sharia compliant or otherwise. Okay, with regards to the principle of accrual basis, so it is considered to be permissible, I would say. Yeah. So there's nothing wrong with the adoptions of accrual basis as a basis of accounting by the Islamic financial institutions. This one is substance over form. Yeah, I would say I don't know why it comes to that. It's the issue of substance over form. Okay, let me see why suddenly it's stuck here. Okay, with regards to substance over form, okay, it says here where the form and substance of transaction must be consistent. It's always expected that form and substance will be always consistent. That means both have the same call it understanding, but shall form contradict with substance, or substance substance forms contradict with substance and vice versa. In this event, okay, if there's inconsistency, the Sharia places greater importance on substance. Okay, all right, what does it mean with that form and substance? Okay, all right, like for instance, a person, okay, a person by form, the name is the name we can see like by name a person is either a male or female, right? Male for like for instance, Abdul. In the form, I mean, Abdul by form, it is a name for a male person, a male individual, for male basically. But if let's say, all right, well, of course we know that name Abdul is for a male, but when it comes to its substance, substance in its not in other words, its anatomy, yeah, its anatomy, its I mean, it's the structure of the body, its behavior, its thinking, its whatever it is. In substance, in other words, it is not representing the name Abdul, which is the form. So in Sharia, okay, they place, I mean, the substance prevail over form. I hope you understand this. Yeah. Okay. Because substance is addressing. I mean, because what is the actual? Okay, what is actual? Okay. And then the issue of probability, where the degree of uncertainty, because we always talk like one of the issue is gharar, for instance, yeah, uncertainty. Okay. But when the degree of uncertainty that the future economic benefits associated with the transaction will flow to or from the financial institutions is considered in reference to the recognition criteria. This is we will be talking further about this. That means you can, I mean, the risk of uncertainty is very you can reduce or can be very can be minimized. Yeah. Time value of money, where a transaction involving time deferment, the assets or the liability is carried at the present discounted value of the future net cash flow or outflow that the transaction is expected to generate in the normal course of the business. In other words, if this time value of money is due to the normal course of business, like we have to discount the what call it the cash flow or either inflow or outflow, um, perhaps due to inflationary. This is something that's what happened in business, so it is permissible. Okay. See that. The application of time value of money is permissible only for exchange contracts, yeah, that involve deferment. Because we have, like, for instance, murabaha, it is allowable that the repayment to be done in the future. That means a deferred repayment. Um, okay. Uh, for only yeah, for that kind of case, but it is strictly prohibited in loan transaction. Yeah. Okay. All right. That is other than that, Islamic financial, okay, this is in terms of carrying value. Okay, so Islamic financial institutions shall present the carrying amount and income and expenses related to deposit and investment in a separate line item. So you will see later next week, sorry, when we look into the, for instance, mudarabah investment and deposit, you will see that there's a different line item to present these two items, yeah, in the financial statements. And where Islamic banking institution has not recognized the investment account as a financial liability in its separate financial statements and consolidated financial statements, the Islamic banking institution shall present the carrying amount of the balance sheet uh, off balance sheet investment accounts separately from its commitments and contingency. This is particularly for mudarabah, yeah, mudarabah, because mudarabah is considered to be a quasi, they call it quasi equity. Quasi means like a hybrid. It has features of investment, but at the same time, it has also features of equity. Yeah, so it shall be recorded separately. Okay. All right. Islamic banking institutions shall disclose the Sharia committee report. You will see that. Yeah. I will share with you on that. Sharia committee report shall contain these informations, the uh, what has they been doing. There are two types normally. They would be doing Sharia review over the processes or in the bank operation processes. They would also be undertaking audit, yeah, so Sharia audit as well. Okay, these are the Sharia what they have been doing. They will be expressing, for instance, contract and related document use. These are Sharia review, yeah, on this part here. I hope you can read through those. Okay, so that's on the Bank Negara. Okay, so Bank Negara has two what call it instruments to govern the the presentation and disclosure in the financial statements. One is through its policy document, and the other one is through its Sharia Advisory Council. Okay. All right, now we go to the last one, which is the accounting standard issued by AOFI, which is referred as Financial Accounting Standard 1. The title is General Presentations and Disclosure in the Financial Statements. Okay. It was first issued in 1996, but the latest revision was done in 2022 to be aligned, consistent with the latest issuance by the IASB on the general presentation and disclosure in the financial statements. Okay. Um, as I said earlier, that FAS is also make reference to a standard issued by ASB, but very important is that we have to be aware of that, although they have uh, sort of like that kind of adoptions, but it is very important to note that, okay, um, the two important aspects, with regards to the AUFI standards, AUFI accounting standard. Okay. Um, in addition to other conventional disclosure, the IFIs stands for Islamic Financial Institution, should disclose two very important aspects of their unique function. One is the role of Sharia advisor or Sharia board, and the second one is the responsibilities of zakat payment. I think the role of Sharia advisor or Sharia committee or Sharia board is basically to supervise the bank's activities and the nature of the advisors on the board's authority following the bank's bylaw and the actual practices with regards to the extent of the extent of compliance to the Sharia principles. All right. What else that they ask? Okay, then the disclosure of significant accounting policies adopted which are not consistent with the concept of financial accounting. This is another word. Any accounting policies that is in contradict with the Sharia, it needs to be disclosed in the financial statements as the notes, obviously. On valuation, the standards require that the policies, basis, and the methods adopted for the revaluation of assets, liabilities, and restricted investment to the cash equivalent value over the historical value. Okay. Um, uh, the third one is the disclosure of earnings or expenditure prohibited by the Sharia. This is very crucial. Okay, this is where it's really can be related back to the materiality concept which I had discussed earlier. Financial statements, it says here, should disclose the amount and nature of earnings and expenditures that has been realized or incurred from sources or by means which are not permitted by the Sharia. Okay, and not just that. In other words, because this, if it is a revenue, it is then should not be recognized by the bank because it is not legitimate from the Sharia principles. Okay, so this amount of non-Sharia compliance, either earnings or expenditure, has got to be disposed. Yeah. So how this gonna be disposed need to also be mentioned mentioned in the statements. Yeah, in terms it says here how it intends to dispose of the assets generated by the prohibited earnings or acquired through prohibited expenditure. Right, disclosure of earnings or expenditure prohibited by Sharia. Again, it is crucial. Why do you think why it needs to be disclosed? Because it is very crucial to enhance the confidence of the stakeholders in the integrity of the financial institution, the Islamic financial institutions. Okay, this is very crucial. Okay. Uh, any Sharia non-compliant activities are expected to be disclosed, and efforts to cleanse the account from the non-Sharia. Yeah, from non-Sharia compliant income or expenses must be made transparent. So these are all a very crucial, very important disclosure. Okay, basically, the public would want to know whether or not the Islamic financial institution engage with any non-compliance activity or prohibited activities. Second, how this Islamic financial institution basically get rid, or in other words, dispose of the revenue, yeah, or assets acquired through this non-compliance activity, non-Sharia compliant activities. All right. Uh, that is on the non-compliance activities. There is another another disclosure which is also important. All right. Related to unrestricted and restricted investment accounts. Yeah. The short term for that in your textbook, perhaps you may come across the word URIA or RIA. URIA stands for unrestricted investment accounts, while RIA stands for restricted investment accounts. Okay, so because restrict, I mean, unrestricted investment account is a what call it? I mean, from its name itself, you can understand that there's no restriction. As in other words, there's no restriction for the bank to utilize the funds, yeah, deposited or invested by the investors under the unrestricted. Whereas for the restricted investment accounts, there are terms and conditions imposed to the bank as how the funds to be utilized by the bank. And bank shall be conforming, or banks are obligated to conform or observe the terms and conditions. Yeah, and that's why, okay, with regards to the banks need to what call it to depool or not to pool this unrestricted and restricted investment account together. Okay, because one, it has specific terms of reference or condition, and the other one, the urea is basically allows, or bank has freedom to use the funds, while the restricted or RIA, bank has certain obligation to observe when banks were to utilize the funds. Yeah, so we will be looking into this again when we talk about mudarabah. Yeah, under the topic of mudarabah. So what needs to be disclosed? Basically, the magnitude or the size of balances. Yeah, in all unrestricted investment account, the distributions of the unrestricted investment account. In other words, the RIA, okay, the urea, and the method used to allocate profits and losses. So we will be in fact learn how to calculate the profit and losses to be distributed to the investment account holders. Yeah, in the following chapter. Okay, so that is all basically for this topic. It's a very short topic, but I would guess that conclude what we learned on Islamic financial accounting system, Islamic financial system, and then followed by a very specific on accounting, which is Islamic accounting. So yeah, then under Islamic accounting, of course, we were talking about, okay, accounting, the debits, the technicality of accounting. We will be doing chapter by chapter, like in after this. But what is also important is, once you have recognized, you have recorded all those transactions, how you will be communicated to the users, to the stakeholders. So this is the topic. Yeah, I mean, how it's going to be guided Okay, in the case of Malaysia, we are bound, Islamic financial institutions are bound to observe the guidelines of this accounting standard. One is issued by the MASB, which is the MFRS 101. Yeah. And the second one, very specific, is the policy documents issued by the Bank Negara with regards to the financial reporting. And that's also another one is endorsement by the Sharia Advisory Council on certain certain debatable issues, yeah, like for instance, accrual accounting, substance over form. The last one is on the materiality, yeah. Uh, time value of money, time value of money also. Some people say it is not permissible, yeah, because it involves a riba, yeah, when you talk about discounting the cash flows. Okay. So I hope that gives you an idea how Islamic financial institutions came up with the financial statements. What guides them, okay, when they prepare the financial statements. Okay. So Khalid, in general, just to share with you again, for why under the compliance of MASB is actually being required by the Financial Reporting Act, Companies Act, and also is Islamic Financial Services Act. Yeah, this is for Islamic financial institutions. If like say the bank, okay, the bank is also is development bank, for instance, is also has being governed by the Development Financial Institution Act. Okay, to summarize, in the case of our Islamic financial institutions, okay, the one that in green, yeah, basically is the main thing, yeah. All right, so it is governed by the Companies Act, Financial Reporting Act, okay, under that, and also MFRS one, yeah. The act is Companies Act. Companies Act requires all financial statements to pre fine, all companies or all entities, okay, form under the Companies Act to prepare financial statements. Financial Reporting Act here specifically for the private sector, it is subject to the subject to not subject, I would say they have to prepare the financial statements based on the MFRS. Yeah. So these are among the relevant MFRS, yeah, particularly for the Islamic financial institutions. Of course, the conceptual framework is going to be very crucial. This gives you the basic definitions of assets, liabilities, yeah, substance over form, maturity, all the concepts, the qualitative quality of financial information are all discussed in the conceptual framework. And then MFRS 101, which I have explained to you in the beginning of the present of the this video, and MFRS 139 is on the recognition and measurements of the transactions on financial instruments, and for the nine, which is this is replacing, yeah, MFRS 9 actually replacing 139. So 139 is no longer effective. Well, when we talk about Islamic Bank, MFRS 4 is not relevant because it is only on insurance. Okay, other things, MASB technical release, yeah, a technical release one on accounting for zakat, yeah. For these statements of financial principle, I would say it is being uh, covered under the MFRS 101. Okay. And also Islamic Financial Services Act, for instance, it mentioned in the policy document, it says only any divergence from the MFRS can only be done if, let's say, it threats the financial stability, yeah, or adequacy of the financial information disclosed. Okay, and the last one is the policy document. Okay, there are two policy documents, but the one that is relevant to the Islamic bank is the first one here, financial reporting for Islamic banking institution. Okay, all right. This is a complete set of financial statements, which I don't have to mention to you. Okay, under the MFRS 9. So you would expect that banks will at least, all right, okay, presents these financial statements of P&L, changes in equity, as well as the cash flow, and of course, not to forget the notes to the account. Okay, this is the pro forma by the Bank Negara, yeah, PD 2022, yeah, PD 2019, yeah, I see. Okay. Well, for AOV, okay, the financial statements FAS 1 2022. All right. The one that I highlighted in bold, okay, is the difference statement or the additional statements, yeah, required by the FAS. Of course, they require a soft P, statement of income, changes in owner's equity, and cash flow. And as well as notes. But on top of that, FAS require two additional statements. One is the statement, this one here. Okay, where is my cursor? The statement of income and attribution related to quasi-equity. Okay, what is quasi-equity? One of the examples is Mudarabah investment. Okay, the second one is statements of changes in off-balance sheet assets under management. Yeah, we will see later what is meant by this. This is on the unrestricted, the restricted investment account. Okay, right. Okay. Well, used to be before its revision, all right, IFAS, which was first issued in 1996, requires Islamic financial institutions to prepare two different statements. One is the sources and statements of sources and uses of funds in zakat and charity. Yeah. The other one is the sources and uses of funds used in the court. Yeah, in the court is a specific funds is meant. Yeah, court is kind of like social financing. Okay, but these two statements are no longer being required to be prepared as a statement, but rather now it is just sufficient to be disclosed as a separate notes to the financial statements. Okay, this is inconsistent with what required by GAAP. Yeah, as applicable by the jurisdiction of the financial statements. Because, for instance, in the case of Malaysia, okay, banks cannot actually, or in other words, cannot act as zakat administrator. Yeah. In other jurisdiction, in other countries, bank may also administer zakat. What I mean by administer zakat is that bank can collect zakat from the public as well as distribute zakat to the rightful beneficiary or asnaf. But in the case of Malaysia, the jurisdictions or the laws says that, okay, zakat is under the jurisdiction of state's government. Yeah, and State Islamic Religious Council is entrusted to manage the zakat. In other words, the collection of zakat from zakat payers as well as the distribution of zakat to the asnaf. Okay, but at the same time, you may come across that some Islamic banks are also kind of quote unquote collect zakat. In that case, bank is not acting as zakat administrator, but is just as a collection agent on behalf of the State Islamic Religious Council. Yeah. So all zakat collection under that agency status need to be transferred all to the State Islamic Religious Council for disbursement to or distribution to the beneficiaries or asnaf. Okay, in conclusion, okay, Sharia compliance and achievement of Islamic goals on financial activities. This is what being aimed by Islamic accounting, and to have an equitable and fair recognition, measurement, valuation, and disclosure of financial information. And lastly, for the achievement of both economic, we are not only concerned with economic, in other words, not merely on profits, but also spiritual well-being of the society. Right? So this is not relevant to your case. So thank you very much.